Well, welcome back to Financial Accounting and Analysis. Let's just make that bigger. There we go. And one more. Okay, so purpose of this little mini lecture here is to give you feedback on the midterm. And the feedback here is relevant for three reasons. One, the final exam will be similar in format to the midterm, so there's lessons here that can apply there. Two, there's a lot of the things here, the lessons learned, that will be directly related to your SMAC assignment. And three, there's a lot of the stuff that we cover here that, looking back on your objectives when you first joined the course, you're looking to deepen your understanding of the financial statements and the what insights you can get from the financial statements and how management actually uses the financial statements. And there's a lot of that was built into the midterm as well. So three good reasons to pay attention to this feedback. One question often asked is, how did I do? So the class overall, the average grade was an 85, which for a graduate MBA class is probably about where it should be. Somewhere between an 80 and 85 is where you expect. You can see each one of you anonymously is one of those dots. So you can see we had folks that got in the 90s, we got folks that got in the 80s, and we got folks that got in the 70s. At this point, you would have all gotten your individual feedback from me in terms of how many points you scored for each question. And if you got lost along the way for each question, I give you feedback of where the mistakes that you made. So that feedback in conjunction with this review should be insightful to you. General feedback: show your calculations, show your calculations, show your calculations. I said it 3 times because it's important. Going forward, I keep saying this, I'm going to take a harder line. So let the record show, if you don't show calculations now going forward, either on homework, midterms, or on SMACs, I'm going to grade it 0 because you got to show your calculations. A couple of you are still not showing your calculations. So one, it's an expectation. Two, if you don't show your calculations, you don't know where you went wrong. So some of these formulas, having a couple of things in the numerator, a couple of things in the denominator. So there's no way of knowing where you screwed up if you don't show your calculations. Answer all the questions. So cases, a couple of you didn't answer all the questions. Some of you do the ratios, and then I ask you to analyze the ratios and discuss the trends, and you kind of blow that part off. So make sure you're answering all the questions. Follow the formulas used in the text. So I got some pretty strange ratio calculations here, and you were clearly using formulas, and remember, there's a lot of variation in terms of people how you use ratios. I've said from the get-go, use the formulas that are in the text. There's that big exhibit in chapter 4. And from chapter 4 going forward, anytime we introduce a ratio, if you're asked to compute it, use the formula that we use in the text. Always, 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 when anyone ever asks you to compute ratios, yes, it's nice to compute the ratio, but the ratio doesn't tell you anything until you stop and think and discuss actually what the ratio reveals. So a classic case is that when you compare in 2 years, what's happening? What's the trend in profitability? What's the trend in liquidity? What's the trend in solvency? What is the trend in asset management between the 2 years? Be careful in terms of what's positive and what's negative. So if we, being an optimistic guy and a guy who thinks positive, there are some ratios when they go up, it's positive. So when the times interest earned ratio goes up, that means you got a bigger cushion provide for your future payment of interest. That's good. But if you're concerned about having too much debt in your capital structure, if long-term debt to assets go down, that's also a positive trend. So don't always assume a ratio going up is good or a ratio going down is bad. Leverage. My old finance professor, Professor Rosenfeld, I hesitate to think how old he is now, but he's the guy who taught me finance, and he used to always talk about debt as a double-edged sword. One time we actually roasted him and we presented him with a sword as part of the roast. So why do I say debt is a double-edged sword? So leverage is the impact of debt in your capital structure. And we know having debt in your capital structure can increase your return on equity. So that's positive. But also when you put debt in your capital structure, it increases risk. Because no matter how you're doing, you got to pay that interest, you got to pay back that principals. So adding debt to your capital structure, having too much leverage is going to put pressure on your solvency, your ability to solve your long-term debt, service your long-term debt. Don't confuse the years. A couple of you made a mistake where we're looking at year 1 and year 2, and you got the ratios reversed for each year. So obviously, if you do that, then your analysis is all screwed up. So double check before you hit send on anything to make sure you haven't confused the years. Statement of cash flows. A number of you didn't do too well on the statement of cash flows. Quite a few of you did extremely well. I could have used your answers as the answer key. So if you're still fuzzy on the statement of cash flows, that is the most important financial statement in this course. And within that statement, the cash flow from operations is the most important part of that statement. So those of you who are analyzing companies, make sure you get into the statement of cash flows. So if you're still confused on the statement of cash flows, I suggest you go back and look at some of the practice problems in the chapters. Take a look at some of the homework problems and solutions. Re-listen to my lectures. Some of you are still a little bit screwed up, and you got things going in the wrong places. You get confused between financing activities and investing activities. Or when you did the operating section, rather than adding something back, you subtracted it out. Or some items you just didn't include, or you got confused. You thought you would have bring in the account balances on the balance sheet as opposed to the actual amounts that belong in the statement of cash flow. So when I go through my review of that, also pay particular attention to when I walk through the solutions on that. With the degree, when you got the problem 9 with the revenues and net income under the percentage of completion, but as I was expecting you to do there is to use completed contract method and use completed contract percentage of completion. Under percentage of completion, the amount of revenue you should recognize is based on the engineering estimate of how far the job is complete. So the engineer said it was complete 30% the first year, 30% the second year, and 40% the last year. Those are the percentages you should use. It's not the amount of cash that's actually received. That's really kind of irrelevant. So some of you put in the amount of cash that was received. Also, if you don't have the percentage from the engineers to how much is complete in any one year, you could use the relationship between costs incurred and total costs. We had the engineering estimate, so that's what you should have used in our problem. And then perpetual, the FIFO and LIFO, a number of you made mistakes here. Remember, under perpetual, LIFO or FIFO, doesn't matter which one. In each case, anytime you increase the inventory, you got to update the inventory records. Anytime you make a purchase, and anytime you make a sale, you've got to go ahead and update the cost of goods sold as well. All right, so that's the general feedback. Now let's go to a new share, and let's go to the actual solutions. So question 1, you had to go through and you had to figure out whether it was, what kind of account it was, asset, liability, stockholders' equity, revenue, and expense, or non-applicable. The only one that you had not applicable was dividends paid. Dividends paid is not any one of those type of accounts. Dividends paid is something that shows up on the statement of cash flows, but it's not any one of those type accounts. Okay, so dividends paid, that would be generally when dividends are declared. They go ahead and they recognize the dividends as a dividend payable. So when you actually pay the dividend, you're actually reducing a liability account. So dividends paid will still up on the statement of cash flows, but it's neither an asset, liability, stockholders' equity, revenue, expense, or account, so it's not applicable. In B, they wanted us to compute the net income for the period. So there's my net income for the period. So you had to look at these accounts and choose the ones that you thought belong there. C was how much has not been profits have not been distributed to the owners. That's your retained earnings. D, what's the total investment? Total investment in this case would be common stock plus retained earnings, which gives you 104. If they had additional paid in capital, you would put that in. They don't have that. And E, how much the customers owe the company. That's the accounts receivable balance. So that's question 1. Question number 2, they gave us a bunch of accounts that were kind of in jumbled order deliberately to test your understanding of those. And then based on those, you had to answer a couple of questions. So what was the amount owed to the company Blue Rifle by its customers? So again, that's the accounts receivable. How much were the total current assets? So you had to add up the receivables, the cash, the inventories. Those were your current assets, totaling $21,700. See how much does Blue Rifle owe to its short-term creditors. That would simply be the accounts payable. And the accounts payable was $5,800. D, how much the Blue Rifle did it distribute to its shareholders? Well, they distributed dividends of $12,000. And then E, do the income statement. So there is my income statement. Question 3, question 3, they gave us an income statement and they gave us a statement of cash flows. So you had to actually draw information from both of those statements and you had to compute these ratios. So operating cash flow to current liabilities, cash conversion ratio, EBITDA, free cash flow, and discretionary cash flow. So these were the ratios. I gave you the formulas from each one as was articulated in the text. So you only had to do this for 1 year here. And then we also, however, look for a little discussion here. So what you needed to do is kind of reflect and comment on each of the ratios above. So if you see when on your grading, if I said your discussion was weak, this is the level of discussion that I'm looking. So you generally want to reflect back on the ratios. And if you don't have the ability to compare 2 years, like in this case, you've just got to comment on what the ratios for this year tell you about. All right, number 4 was the big one. And this is the one you really need to master because this is the most important financial statement in the course. And this is the statement of cash flows. So errors that were made here, couple. First of all, some of you put things in the wrong place. So you had investing activities that were financing activities and vice versa. 2, you've got to be, for the operating section, this is where a lot of the errors were. You've got to add back any non-cash expenses like depreciation. Then you need to work through the current assets and current liability having to work through in operations. And some of them were subtractions. So the increase in accounts receivable, increase in inventory were subtractions, increase in prepaid expense was subtraction. You increased accounts payable, that would be back in addition. And you reduced wages payable, that would be a subtraction. So the rule of thumb there, if you're increasing a current asset that's used in operations, it's a subtraction. If you are increasing a current liability, that's actually an addition. So the counter of that would be true as well. So if you actually reduce a liability, that would be a reduction. So there's my cash flow from operations. Going to be losing my voice here. I'll show you how we got the investment account of $5,300. That was the actual investment. There's a calculation. I'll walk you through that in a moment. And then for financing activities, you had this issuance of stock, you had the reduction of long-term notes, and then you had a calculation for dividends. So your total change in cash, if you consider the net effect of the operations, the investing, and the financing, was down $25,700. Add those all together, and you get a reduction in cash of $5,800. You add that to the beginning cash, and there's your cash at the end of the year. How I calculated these things, the equipment purchase, excuse me, you know what the beginning equipment was, you know what depreciation was, you know what ending equipment was, so that what the missings you have to solve there for the X, and X would be the actual purchase of equipment. And as far as the dividends that were paid, here was your beginning retained earnings, here was net income, here was your ending retained earnings. So you solve for X, and that gives you dividends declared of $24,000. Number 5. Number 5, we were given very simple information from the balance sheet, total assets and total stockholders' equity for 2 years, given basic information on the income statement, net sales and net income for each year. And on the basis of that, you had to compute these ratios. So return on equity, return on assets, return on sales, asset turnover, and financial leverage. So very simple calculation here. So return on equity, net income divided by equity, return on assets, net income divided by assets, return on sales, net income divided by sales, asset turnover, that's going to be your sales divided by your total assets, and financial leverage would be your total assets divided by your stockholders' equity. So here's the calculations that you get. So once you get the calculations, then what you need to do is you need to go back and reflect on the calculations and see what the actual trends are. Okay. So what I would have noted here is that the return on equity was pretty close each year, but you had a significant increase in return on assets, The return on sales was down. Your asset turnover was way up, and your financial leverage was actually down. Okay, so those are types of things that you should have reflected on. Right. Number 6, you were given different information. You were given information on the total assets and stockholders' equity and information on the income statement. And what we wanted you to do was we wanted you to use the ROE model, the framework, to assess their profitability for both years. So we wanted you to compute not only return on equity, but we wanted you to compute the components on there. So we wanted you to get the return on sales. We wanted you to get the asset turnover. We wanted you to get the financial leverage. And so you weren't just supposed to do return on equity. So the return on equity is significantly down. It went from 20% down to 14%. But you had to actually discuss the trends in each of the different areas here. Okay, so return on sales is down. Asset turnover is up significantly. Financial leverage is down. So the net impact of all of those is a reduction on return on equity. But you needed to discuss each of the components of those things. All right, so as far as number 7, we gave you a comparative balance sheet and we asked you 2 things. So evaluate their solvency by computing long-term debt to total assets, long-term debt to shareholders' equity, and interest coverage. And then we wanted to say what other debt might appear in the footnotes to the financial statements that may not affect the firm's credit risk. So things that show up in the footnote, the big one I was looking for there were the future lease payments. Could have also talked about contingent liabilities and so forth. That's the B part. That's stuff that ends up in the footnotes. But getting back to the A part, you had to compute the ratios. So long-term debt to total assets. Some of you, where you messed up here was you looked at the debt. There was the current portion of long-term debt. So there's the long-term debt. That's in the long-term liability section, but you also had a current portion. So a couple of you forgot to add back in the current portion of long-term debt. So your ratios were off slightly. I didn't take off a lot of points for that, because you would have had the same area would have back through when you did long-term debt to stockholders' equity. And then you got the interest coverage ratio here. So you take the so there's your interest coverage. Go back here. Okay. All right. So as far as the trend in ratios here, long-term debt to assets. So you get an increase, so the company is becoming more leveraged. Long-term debt to stockholders' equity, big increase here. And your interest coverage ratio, okay, your interest coverage ratio is gone down, but it's still, that's a 19.3 is still a nice cushion to have. So I would say that they still do have a nice cushion there. All right, and then here's a discussion of each of the ratios. Here's the little comment about the footnotes as well. All right, that was 7. And number 8 was you had to do an aging schedule. And once you did the aging schedule, you had to figure out what the bad debt expense was. You had to figure out what the net realizable value was. And you also had to come up with what the total accounts receivable was. So here's the schedule. So there's the here's everything all broken down here in terms of how much is actually the total accounts receivable that they have. Here's my of that accounts receivable, what I proved to be collectible. But what you had to bear in mind here, so your bad debt expense was not 13,856. You had to account for the fact that you had a $360 balance in there to begin with. So your bad debt expense is actually 13,496. Okay. And here is your total accounts receivable. So your net realizable value would be your accounts receivable minus your allowance for bad debts. Number 9 is you were given information about a long-term construction contract, and we wanted a brief income statement for a percentage of completion and completed contract, and which one better represents the profitability. So the one that better represents profitability would be the percentage of completion, because it matched costs and revenue each year. Completed contract, you're going to recognize all of the net income in 2020. You'll see under completed contract, we represent a portion of the profit each year. Now, the biggest mistake that was made here was the estimated revenues. So the estimated revenues was $10 million, which was also the total amount that we received. But the recognition of revenue is not the amount received. It's the percentage of income that should be recognized on the contract based on the engineering estimates. So engineers based 30% the first year, 30% the second year, and 40% the fourth year. That's where I got these numbers. So you can see here the 510 the first year, lost 100,000, then made 890. Total impact here is 10,000 worth of revenues, 8,700,000 of expenses, so net income of 1,000,003. For the completed contract, most of you who lost credit on this was because you didn't tell me what the actual expenses were. So you needed to show an actual income statement for that last year. So your total revenues minus your total expenses would give you the 1,000,003. And as I said earlier, the one that is the best method that could give you the best matching would be the percentage of completion. And then the last one, you were given detailed information on the inventory, on the purchases of the inventory and the sale of the inventory. And part A, what would be the ending inventory and cost of goods sold under FIFO, what it would be on LIFO, how much would they save in taxes by using LIFO, and get their inventory on hand under both the LIFO and FIFO. So here's your detailed schedule. So under perpetual, you've got to, after each transaction, you got to update the ending inventory, and you've got to update the cost of goods sold. And as you work this thing through, what you needed to come up with under FIFO was 810 was your ending inventory, and 6,890 is your cost of goods sold. LIFO, last in, first out, after each transaction, but your cost flow assumption is different here. So the stuff that most recently came in is the stuff that you're going to get rid of. You're also updating after each purchase and each sale. So you had 2 purchases. Okay, and then you had the number of units sold. Okay, and notice you're going to be selling your most recently purchased units here. Then you had another purchase, and then you had another sale. Right, so under this method, here's your ending inventory, and here's your cost of goods sold. See, how much would they save in income taxes if they used LIFO? So basically what you got to do here is you got to compare the 2 cost of goods sold. So cost of goods sold on the LIFO is 7,100. Cost of goods sold under FIFO is 6,890. So the difference before taxes is 610. You get a 30% tax rate. So your actual tax savings is $63. Inventory on hand, quite a few of you screwed this up. Either you brought in the wrong formula. So when we get inventory turnover, okay, inventory turnover is cost of goods sold divided by ending inventory. That's how we do inventory turnover here. And the inventory on hand is 365 divided by the inventory turnover. So under FIFO, you've got almost 43 days worth of inventory on hand. On the LIFO, you got much less. So your little discussion there should have said that LIFO would actually give you the more favor. There's another case where having a lower ratio is better. So you're probably better off having lower inventory on hand. Okay, so that concludes the review of this. Let me do a new share here. Let me go back. So overall, again, I think I was the results were pretty good. Do remember going forward. Let me get rid of this here. Get rid of floating meeting controls. It's not easy to work in Zoom and you're losing your voice and you're tired and it's been a long day. Come on, mouse. Okay, I think I'm just going to stop right here. Okay, I'm back again. My mouse is getting tired. So just going forward, remember, always show your calculations, always answer all questions, use the formulas and that we provide you with, always discuss the ratios. Don't assume all ratios are good if they go up and they're bad if they go down. Remember, leverage is a double-edged sword. Don't confuse years. Remember to practice your statement of cash flows. And remember, when you do percentage of completion, base it on the engineering estimate. And be careful with perpetual LIFO and FIFO. Remember, you got to update your records each year. Okay. So that concludes. I think I'm about ready for a new mouse here. So that concludes the lecture. Hope you found that useful. And I will try to get my way out of here. So you may end up with some dead time here. Oh, there's my floating controls back. So until next time, adios, hasta luego, au revoir. Be well, everyone. I hope you found this review useful.